Hello, everyone. Thank you for making the choice to invest in your business and yourself by joining today's CE accredited financial planning session. 4 ways to help your clients get the most from their money during retirement. My name is Alex Mercer, and I'll be your host today. I'm joined by my colleague Steve Arnott, Financial Planning Project Lead, who will provide today's demonstration and run the Q&A. Please be sure to remain for the full session today as that is required to obtain the eligible continuing education credits, which include one CE credit in the category of financial planning for FP Canada certificates and or one CE credit in the category of professional development for MFDA licensed representatives. About an hour after the session, you will receive an email which you need to respond to with your full name so we can accurately create and send out your certificate. In the subject line, it will say action required. So it will be very clear that that's the email that you need to action. And we will have those certificates sent out no later than October 1st. Additionally, we've got an exclusive offer for those of you who stay with us until the end and would like to explore a free trial of Snap Projections financial planning software. Before we get started, I'd like to do a quick tech check just to make sure you can all hear me and see my screen. Can I get some of you to send a quick yes through your question tab or even a smiley face? Just click the arrow beside the word question and a window will pop up where you can type and hit send. This is exactly how you'll send any questions you have throughout the session. Wonderful. Thank you, Matt, David, Shelly, Jennifer, Simon, Brett, I appreciate it. Glad to know you can all hear me and see my screen. So Steve and I are going to turn our cameras off. We did just want to say hello and show our faces, but we'll turn them off so that you can all have a full screen view of our presentation today. So I'd like to start with introducing you to today's case study client, 64-year-old Sonia Hayes. Sonia is single with no children. She was born January 1st, 1959, and she resides in Alberta. She is in her first year of, or sorry, her final year of working as an HR manager and is beginning to prepare for the transition of working and investing to retiring and drawing on her savings. We've asked our longtime client to come into the office today because we want to ensure we've thoroughly investigated all potential avenues to help Sonia make the most of her money throughout this next life stage. Today, we're going to walk Sonia through a personalized strategy session where we will discuss and model when to start taking CPP and OAS, the best order to withdraw from her different accounts throughout retirement, whether or not she should use home equity, and determining how much Sonia can afford to spend each year to ensure she doesn't run out of money. For those of you who aren't already familiar with Snap Projections, Snap is a transparent, easy to use, and highly flexible financial planning software. We help great financial advisors grow their assets under management and receive more referrals through effective financial planning. Our mission is to help Canadians make better financial decisions so they have peace of mind while they work and a better quality of life when they retire. We execute this mission through working with great financial advisors like yourselves who embrace financial planning because we believe this is the best way to provide sound financial advice to Canadian consumers. As the wealth management industry continues to transform, there are endless opportunities for advisors to lead with financial planning as a way to enhance their service offering, strengthen the relationship with their clients, gain more referrals, and as a result, grow an incredibly successful financial advisory practice. If you're wondering what other advisors have to say after using Snap Projections or how we compare to other solutions, you don't need to look any further than the reviews page on our website. Many advisors are currently using Snap Projections to provide financial planning for their clients and grow their practices. Matt Pointer said that even as a beginner, he was up and running after just a few practice sessions. Margaret Richards says that Snap Projections has the best support system of any financial planning software she has ever used, and she's tried at least 10 of them. David Cook says he fretted over 2 complicated plans for 3 months, but after signing up with Snap, was able to complete them in less than an hour each. And you're about to see just that. During this hour, you will see Steve build a plan from scratch and then use that base plan to create multiple what if scenarios in real time. So let's take a moment to think about the why behind financial planning. We all know it's good for the clients, but what is the real value of having a financial planning process in place for you and your practice? We know that investment and insurance products are essentially the implementation part of a financial plan. Without the plan, how can you effectively communicate the value of your recommendations? Snap has been in the market and speaking directly with advisors for nearly 8 years now. What we have discovered is that successful advisors and successful advisory teams pretty much always have a financial planning process in place. Sometimes it's a light process, or maybe it's more in depth. That's going to depend entirely on your client base and what their needs are. But the common denominator to building a sustainable and growing financial advisory practice is almost always the same. A financial planning process is in place. Without that process, it's going to be harder for you to build a sustainable and successful practice. Financial planning helps to create the foundation for a strong client-advisor relationship. It builds trust. That trust makes it easier to deliver financial advice and provide behavioral coaching so that you can help your clients keep their emotions in check and avoid doing things like buying high and selling low. There have been studies on the value advisors can add to their clients' lives through relationship-oriented services. Morningstar calls it Gamma, and Vanguard calls it Alpha. If anyone wants these studies, let me know, and I'd be happy to send out the links. Since financial planning focuses on addressing direct and practical questions for clients, it drives value. When you're speaking your client's language and meeting them where they're at, they talk about their experience to friends and family, which keeps the referral and client acquisition wheel turning. Building trust from the onset makes it easier to turn those prospects into clients. Happy clients stay, which means that financial planning also increases the lifetime value of a client. Succession planning would need its own dedicated session, but it's been proven time and time again the concrete value financial planning brings to the table when it's time to sell your practice. So, with all that value that is generated from financial planning for both the clients and the practice, why aren't more advisors doing more planning? Here's what advisors tell us. Problem number one, data entry takes me too long. It can easily take hours or even days to collect the information from clients and enter it into a planning platform. Problem number two, it takes me hours to develop the projections. One plan alone can take 15 to 20 hours, and that just isn't scalable for the mass affluent market. Problem number three, my clients don't want or understand complex 50-page reports. Their eyes glaze over. Lastly, problem number four, I can't run quick what if scenarios with a client in real time. Often, the adjustments and discussions throughout the planning process turn into multiple back and forth meetings that take up everyone's time. So now let's hear from you. We have got a good sized group here today, so it is time for a poll. You should see this pop up on your screen in just a few seconds here. So I'd like each of you to tell me which one of these problems represents your top financial planning challenge. Don't overthink it. If all of these apply to you, which is often the case, select the one that you find the most painful to deal with. All right, get those answers in because we have got to move on More than half of you have voted. So I'll give you guys a few more seconds here, and I'm going to share the results so we can see where you all stand as a group. It's always so much fun to see where everyone is together. So 5 more seconds here, and then I'm going to close that poll. So get your answers in. So closing the poll now, and let's share the results and see what you all had to say. That should be popping up on your screen. There we go. Very interesting. Okay, so 10% of you are saying other, which means that 90% of you here today are falling into one of these 4 buckets. We've got a pretty even split, three front runners here, but it looks like it's taking most of you way too long to develop your projections. Your clients don't understand your reports, and you can't run quick what if scenarios in real time. So thank you everyone so much for participating. It's so much fun to see where we all stand as a group. So you're probably wondering why I'm asking you this question and how Snap is going to solve these challenges for you. So for those of you who said that data entry takes me too long, data entry does not have to be a problem for you anymore. Snap is going to provide you with a questionnaire that simplifies the data collection process, ensuring you get the information you need, plus provide you with a streamlined process to quickly and effectively enter your data into the software. You're going to see Steve do that in just a moment. Now, for the biggest group of you, the 25% of you who said it takes me hours to develop the projections, it should not take you hours and hours to build simple plans. With Snap, you can build a basic plan in less than 20 minutes. You'll see that shortly here as well. And for the 23% of you who said your clients don't understand your reports, what good are those reports if your clients can't understand them? Snap provides you with clear, engaging reports that have been designed for your clients. You have complete control over what's included, and you can also provide interactive live presentations that will demonstrate how your plan helps your client meet their goals. You'll see the interactive charts that are part of the reports live in action here today. And for the 24% of you who said, I can't run quick what if scenarios in real time, building up multiple what if scenarios should not be a cumbersome process. It should be simple and easy enough that you could do it with clients present and even prospects if you wanted to. With Snap, you can build multiple what if scenarios in real time. A few clicks, a few seconds, that's it. And you're about to see Steve do just that. Now, the reason that Snap can address these challenges for you is simple. This is a financial planning software that was designed with advisors for advisors. We believe there are 4 core elements that are absolute essentials for any good financial planning software. Critical element number 1 is transparency. When you need to explain something to your clients, you need to first be able to understand it yourself. I talk with advisors all the time who tell me that if they cannot see how the numbers are being calculated, they feel uncomfortable presenting the plan to their clients. It doesn't mean they need to run every calculation, but they need to be able to understand how the numbers were generated so they can conduct an audit if they need to. Some platforms almost seem to hide the calculations, so advisors have no way of verifying the numbers. There's just no transparency. Next comes flexibility, customization, and control. Your clients' lives can be very complex at times, and it can become difficult to model. As the advisor, you need to have a very high level of flexibility and control over the plan if you want to model those lives accurately and make the plan personal for your client. For example, you should not have to lump multiple TFSAs together because your software isn't flexible enough to allow for multiple account types. Those types of restrictions can seem insignificant at first, but are often found in practice to make data entry cumbersome and create confusion for clients. Next, good financial planning software must be easy to learn and easy to use. Lack of ease of use is one of the biggest barriers to software adoption. If it's hard to use and the learning curve is steep, no one is going to want it. Last, but certainly not least, comes customer support and service. Here at Snap, we provide industry-leading customer support because we know it is a crucial component to your success. Our team provides dedicated one-on-one training sessions and regularly hosts drop-in sessions and live webinar tutorials. We understand that when you need help, you need it right away. Plus, the team will screen share to ensure the best possible experience. If you have used other planning software before, it will come as no surprise to you that screen sharing is not an industry norm in the financial planning software industry when it comes to customer support. Steve and the team behind him will be there for you every step of the way. So what you're about to see here as I hand this over to Steve is that Snap will show you where the numbers are coming from. You'll see how much flexibility and control you have within the software and how straightforward learning to use the program will be. Steve will start with showing you the basic profile setup in Snap Projections. As an existing client, we would typically already have this set up for Sonia, but we want you to be able to see the entire process from start to finish. To run a simple projection and answer some basic questions, we just need to enter a few data points: name, date of birth, province of residence, income, current asset holdings, and any planned contributions. That's it. And what you'll see here is that this data entry process is only going to take Steve mere minutes, and that includes him taking the time to explain the steps as he goes. You'll see that with Snap, we can be quick and simple, or we can conduct comprehensive financial planning. So I'll get Steve to take over now and log into Snap.
Terrific. Thanks so much, Alex, and thank you again for everyone who's joining us today. Snap Projections is a web-based platform, which means that you can access your account from any Chrome browser on any computer without the need for a download. You'll go to snapprojections.com, and then in the top right corner, you can click Login to enter your username and password. We also have the option to enable multi-factor authentication for added security. I've entered all that during today's session, so I'll click Login and go directly into the software. I land initially on the clients page, which is where I can view all of the plans that I've created previously. I can click on the client in order to access those plans, make copies, and run additional scenario analysis, or I could make changes if a client has provided me new information, and I can also create customized PDFs for client delivery. Today, we're going to be clicking on Add New Client, and we're going to be setting up a plan for Sonia Hayes. So we've entered her name, date of birth, province of residence, and you'll see in the top left corner that there are three key sections to the Snap software. There's the scenario setup flow that we're currently in. This is where you can enter your client's expenses, incomes, assets, and more. Once you're done entering the base data, you'll be able to proceed to the planning pages where all that information comes together to show your client's life on one page. You can make changes to annual values, customize any information that you'd like, and then you can proceed to the client report where you can choose which charts and tables to include and add additional commentary as desired. For now, we're going to continue through the scenario setup, and I'll click Next to go to the general settings page. At the top, you'll see that we have the option to import the FP Canada guideline assumptions for rates of return, inflation, and other assumptions. So you can use these as your starting default. This is what's pre-populated in Snap when you first sign up. And as we scroll down, we're going to customize some of the values. So we have Sonia retiring next year at age 65. We'll run the projection until age 100. And then we see the FP Canada guideline assumptions as our pre-filled values. So we'll leave inflation at 2.1. And then we have cash, fixed income, and equity based off of gross expected returns. So in line with the recommendations, we're just going to reduce these by the expected management fees. So I'll set those as 1, 2, and 5%. I'll click Next, and we'll go to the expenses input page. Sonia's looking for $54,000 per year starting in the first year of retirement, and SNAP will automatically index this forward for each year of the plan. So she'll be able to maintain $54,000 a year of current purchasing power. I'm also going to add an additional expense that we want to itemize within the projection. So this is going to be for additional travel in the amount of $10,000 per year. We'll assume that that increases at the rate of inflation each year. We could set a custom inflation rate if we wanted to increase it at any different value. And we're going to start at age 65 and run that until age 69, making the expense every year. We'll also highlight that in our chart so that we can draw attention to the fact that her travel goal is fully funded in her projection. So this is just adding a $10,000 a year expense on top of the $54,000 base. And we can do that for as many expenses as we'd like in terms of adding car purchases every 5 years, gifts to kids in any one future year, or whatever other expense you'd like to itemize within the projection. I'll click next and go to the incomes page. Sonia is currently earning $125,000 per year. You'll see again that we can customize the indexing rate as desired. So I'm just going to change the 0 and link that instead to the general inflation rate in the plan. It's being input as employment income, so SNAP will automatically deduct CPP and EI. It will calculate the appropriate taxes and then track the RSP room. And it will stop that in the final year before they're set to retire. We could add additional incomes if we had rental income or any other source, and we can add defined benefit pension plans with or without bridge benefits. Proceeding to the assets page, you'll see that there is a non-registered account added to the plan by default. This is to provide two things. The first is that it shows you how to add a capital asset and enter the asset allocation. The second is that it gives the projection somewhere for future surplus cash flow to be allocated if it's expected to occur. Because I'm going to be adding accounts for Sonia that she has today, I can delete the default and replace it with her existing accounts. So we'll input a non-reg account with a balance of 250,000, and that's invested as 40% fixed income, 60% equity. I'll add a tax-free savings account for 100,000, similarly invested as 40% fixed income, 60% equity. And finally, I'll add an RRSP with a current balance of 600,000, invested as well as 40/60. You'll see that for each of the accounts, my rate of return preference has been pre-filled. So I could click on any of these values and change the rate of return assumption for that specific account if I expect that the fixed income or equity allocation will receive a different rate of return than my base assumptions. You'll also see that SNAP is calculating the total portfolio return based off of the blended assets, and that's what will track and determine the growth rate of the account. Across the top of this page, you'll see that there are tabs for tax-free savings, RSP, DCPP. This is a common theme throughout SNAP, where you'll see that there are additional customizable settings that you don't have to interact with. You can create a base projection with simple and conservative assumptions, or you can come in and update these values with your client's notice of assessment information or other customized details to make the plan more tailored. In this case, I'm just going to leave the TFSA contribution as a single year's worth of room. For the RRSP, I'm going to update the base assumption from 22,000 up to 30,000 based off of her most recent notice of assessment. And then I'll go back to the table of accounts and scroll down to add in her home. So I'll click Add Real Asset, current value of 750,000, and an original cost base of 400,000. And we're going to assume that this appreciates throughout the plan at the rate of inflation, and you can customize that as desired. We have the option to purchase a real asset in a future year or sell a property. So if you wanted to save up for a home in a client's plan or buy a cottage or investment property, you can do so here. You can also model downsizing or liquidating a home in a future year in order to provide additional cash flow that can be allocated to other purposes. I'll click next and we'll go to the debts page. Right now, Sonia's paid off her mortgage and has no outstanding debt, so we'll leave this blank and go to the government benefits page. Once again, you'll see that SNAP has pre-filled the CPP assumption with a conservative base assumption of 55% of the maximum. So this is the national average benefit that individuals receive Based off of Sonia's employment history and income level, we're going to assume that she receives closer to 80% of the maximum. So when I enter that value, you'll see that SNAP automatically calculates what her expected benefit will be based off of a start age of 65. You also have the option to enter in the exact dollar amount if your client's already receiving CPP, or if they've received a Service Canada statement that shows how much they're going to receive. As we scroll down, we'll leave the OAS assumption as 100%, but that is customizable, similar to the CPP benefit. And just like that, in about 8 minutes, we've been able to input all of our base data for Sonia's plan. On the left, you'll see that there are additional pages available in the scenario setup flow. We could add insurance policies, conduct life needs analysis to see if there's additional insurance that could be recommended. We can add RESPs, corporations, and customize additional settings. But for now, we're going to proceed to the planning page where all of this information will come together to show us how Sonia's her financial information will progress over time. So I'll click planning pages and we'll see what that looks like. Now this page may seem overwhelming at first glance, but once you know what you're looking at, it becomes incredibly intuitive and very powerful for your planning needs. On the left, we have the year and our client's age. We then see the calculated discretionary spending that SNAP has determined Sonia should have available based off of our current inputs in the plan. So this is taking her employment income of $125,000 per year. It's subtracting off her CPP and EI deductions, her taxes payable, and then allocating the rest towards spending. As we scroll over to the right, we can see key information about tax rates. We can see her investment accounts and how those are growing throughout the projection. We can see the home and the calculated estate information. And we can also customize any of these values on an annual basis. So if I come to the tax-free savings account, I can make a contribution for this year of $6,500 and then apply that to the plan. Now you'll see when I make this contribution, the run scenario button in the top right will turn red. So rather than constantly moving all of the numbers on you as you're making changes to this page, we wait so that you can reference any numbers, make all the changes that you need, and then you can click Run Scenario to apply those changes and get all of the new numbers with those updates in place. So now the TFSA value is higher and the run scenario is green, meaning that this plan is currently up to date. Similarly, I'm going to contribute $22,500 into the RRSP, and then I'll once again click Run Scenario to apply that update. And this now provides the base scenario that we'll start discussing with Sonia. So we have her first year of work. We have $67,000 as the calculated discretionary spending that she should have available once her contributions are factored in. She's then planning to drop that slightly next year once she retires, and she's going to spend $54,000 a year all the way throughout retirement. SNAP is going to index that value at the rate of inflation in our plan. And then we can see we've also given her an additional $10,000 a year of travel expenses. On the right, we can see that SNAP is automatically withdrawing money from the capital assets in order to supplement her CPP and OAS. And then once it depletes the non-reg, it moves on and starts using the TFSA in addition to the RIF minimum to supplement her spending until age 95, when we can see that the RSP runs out of money. And then we can see that there's an annual shortfall being calculated and tracked in the plan. So as a base projection for Sonia, we can update the title of the scenario. We'll call this base projection with shortfall at age 95. We can also view the plan in charts by clicking on the charts button in the top right. The first chart we have is the cash outflows. So we can see her base expenses. So this is kind of her standard of living, her base consistent lifestyle expenses each year of the plan. We can see the travel itemized for the first 5 years of retirement. We can see her income taxes drop off in the first 7 years while she's predominantly using non-registered and TFSA money. And we can see the capital asset contributions that she's making in her last year of work. If we look at the total inflows, this shows us that in that last 5-year period, her inflow is roughly 40% of her calculated spending needs. So while she's able to spend some of her needs, she's not able to meet the full expected cash flow. If we scroll down and look at the cash inflows, we can see that shortfall here. So there's a gap once she runs out of RSP money, and she's fully dependent on CPP and OAS for that period. We can also view it in terms of her total assets. So we have her capital assets gradually depleting throughout retirement, and then we can see the shortfall building up at the end of the plan. And we can interact with any of these charts by clicking on the legend items. So now I've removed the real assets, and that just allows us to focus the conversation on more of the liquid net worth and how much she would be short in the final years of the plan. So now we have our base projection for Sonia. This is a plan that we may have already had in place because Sonia is an existing client, but we wanted to show you how we get to this first stage, starting right from scratch. So now what I'll do is take a look at Sonia's questions that she came to us with today so that we can help her decide on things like CPP and OAS timing, withdrawals, using home equity, and how much her maximum spending might be given some of the changes that we'll make today. So the first question is when to take CPP and OAS. So we'll come back into Snap so that we can start to answer that question. We're going to copy this base scenario so that we can run alternative projections. I'll click on the title and change it to Scenario 2, Defer CPP and OAS. So right now we can see CPP and OAS are starting at age 65. And before we make any changes to this plan, I'll direct your attention to one of the research papers that we've included in today's session. So if you go to your GoToWebinar portal, you should find in the handouts 3 PDF files. One is a series of tools provided by Snap Projections, and then the other 2 are research papers that the FP Canada Research Foundation has published, one related to CPP, QPP timing and delaying benefits, and the other relating to retirement drawdown choices, which we'll review shortly. You can also find these papers by going to FP Canada Research Foundation and reviewing any of their recently released reports. So for the CPP, QPP delay benefits, there's some great calculations and language that you can use with your clients around the decision process. So a lot of people know the pros and cons of delaying CPP or QPP, but it can be really important to properly position the pros and cons so that your client is able to make an informed decision that's going to help them to best meet their goals. So in order to make a decision about whether to defer or not, we really want to focus on what Sonia's needs are. So as a single individual, she doesn't need to worry about her estate as much. She's really focused on minimizing the chance that she runs out of money before she passes away. So we'll go to Scenario Setup and then Government Benefits. And here we can change the CPP start age. So we'll change that to 70. And when I do, you'll see automatically Snap increases the expected CPP benefit and shows us the deferral calculation of how much additional benefit she'll receive once she begins taking CPP at age 70. I'll go back to the planning page to see the impact on the projection. So now we have 0 for the first 5 years of the plan, and the CPP benefit jumps up as of age 70. If we scroll down, we can now see that there's not a shortfall until age 97. So by deferring CPP, we've pushed out her shortfall by 2 years and given her 2 additional years of expected spending. If we come back up in the plan, we can go to age 90 in order to start to have a conversation about the pros and cons of this deferral. On the very right-hand side of the planning page, you'll see that there's a section for the estate before tax. And if I click on that value at age 70, I'll get a summary of what her finances would look like if she passed away at age 70. So she'd have roughly $800,000 in each her capital assets and her home value. She'd owe $350,000 in taxes, and she'd be left with about $1.4 million. If I compare that with our first scenario where I started taking CPP right away, I can see that I would have a higher final estate value after taxes by taking CPP at 65 versus at 70. So if she passes away early, then yes, taking CPP or deferring CPP is going to be worse for her. But if that's not her primary goal, and if delaying CPP allows her to prolong her capital assets, that's where we would make the recommendation for her to take the deferral. We can do the same thing for OAS. So we'll go back into government benefits, scroll down, change the 65 to 70. We'll see the update automatically and Snap's calculated deferral benefit. And now as we scroll down, we'll see that we've pushed it out a year further. So now we're running out of money at age 98 instead of 97. So in both cases, deferring appears to be the right approach for Sonia and her particular goals. So now we have no government benefits for this period, and we can see that SNAP is automatically withdrawing the required money directly from the capital assets in order to meet those spending needs. So I'll go back to Sonia's list of questions, and we'll make the recommendation that she defer both CPP and OAS given her current financial situation and her goals. Her next question is about determining the best order to withdraw from her different accounts in retirement. So we'll go back into SNAP, we'll copy this plan, and we'll run an alternate drawdown analysis. So coming over to the capital assets, you'll see that SNAP follows a default of using the non-registered money. It does automatically take RIF money if there's, or RSP money if there's no taxable income for the year. So you'll see the effective tax rate and total taxes are 0. So it takes some money out if it's able to do so tax-free. But for the most part, it's using non-registered money, then tax-free, and then RIF money. Before we make any changes, we'll just draw your attention again to the recent research on retirement drawdown choices. So when to take accelerated RIF payments, what the pros and cons are, and what unique client circumstances might suggest doing one approach over another. The main takeaway from this research is that when you take RIF money early in a plan, you're typically exposing it to non-registered investment taxes. So the longer that money sits in a non-registered status, the more tax drag there is on the returns, and the more likely the gradual tax drag is going to offset the benefits of the early RSP withdrawal. It also comes back again to the client's goals. If you deregister money early and the client passes away early, then you're going to leave them with a higher estate than if you were to wait to take that money. So if a client is primarily focused on estate, you may want to deregister early. If they're primarily focused on longevity, then you may want to follow the default algorithm in SNAP, which is to defer taxes and defer registered withdrawals. So we can do that analysis for Sonia. We'll click on this gear symbol in order to show the cash flow management order, which is how we can control the sequence of withdrawals in the software. So we'll see this new section called cash flow management order. And under withdrawals, we'll see that it starts with non-registered, then TFSA, and then registered money. We could click on that and change it to take registered, then non-registered, and then TFSA, and we could copy that down until age 100. Now, when we look at the withdrawals, you'll see that everything's coming out of the registered account down to depletion, then it turns to the non-reg, and then it takes from the tax-free savings. And as a result of that change, we've now brought the shortfall year back to age 97. So it was 98, now it's 97. So for Sonia's goal of prolonging her assets, this doesn't appear to be the right approach. However, for a client that might be more focused on their estate, if we go to age 80 and scroll to the right to click on the estate before tax, when we compare scenario 2 to scenario 3, we've actually increased the after-tax estate value by taking RIF money early. And that's because we've gotten rid of this large tax on estate bill by deregistering everything out of the account. So again, it comes back to what is your client's priority? What are their unique financial circumstances as to which strategy might make sense? And SNAP gives you the key information around effective and marginal tax rates. It would show OAS clawback if that was applicable, and then it can allow you to compare things like the year of shortfall or the after-tax estate value to help show your client which approach is ideal for them. One other solution that we could try is to go back to the default, so non-registered, then TFSA, and then registered. And then instead of taking all or none from one account or the other, we could choose to blend withdrawals by going to the assets page and then the RSP/RIF tab, and then changing the conversion age of the RSP from 71 to 64. So now SNAP is going to take the annual minimum RIF payment starting in the first year of retirement. So we can see it's taking about $25,000, and it's supplementing that with non-registered withdrawals. And as we scroll down, we can see that in this case, by blending withdrawals, we've extended her shortfall to age 100, which has been the best case scenario so far. And we can see two reasons that that's happening. The first is that even with taking the RRIF withdrawals at the start, because we're deferring CPP and OAS, there's very little taxable income. And so there's very little taxes payable, and we're getting a lot of that money out of the account in a tax-free manner. So that's a unique circumstance that Sonia is able to take advantage of. The second reason that this is advantageous is that if we look at the value of the non-registered account, as we scroll down, we can see that it gets used up by roughly age 80. So the money that we are taking out of the RRIF early is being used up fairly quickly in the plan. And so it's not exposed to those long-term tax drags that would occur in a non-registered status. So for those unique circumstances, this particular strategy is ideal for Sonia. So we can go back to her list of questions and confirm that. So we recommend converting your RSP to a RRIF at retirement and then taking supplemental income out of your non-reg account. Her fourth question is about whether or not and how to use home equity in the plan. So if we go back to the projection, we can see the value of the home each year. And at the end of the plan, even though she's run out of capital assets, she still has about 1.6 million of future equity in the home. So we could use this either through a line of credit, a reverse mortgage, or we could do a downsizing in order to unlock some of that capital and reinvest it in the plan. So we'll do that in this case. So we're going to copy this scenario first. We'll change the title. And then we're going to go into scenario setup and assets. And then we'll set a future sale age of 75. When we go back to the planning page, we can now see the home and it has a value until age 75. So it's sold for $942,000. And then we can see the proceeds are being allocated automatically between the TFSA and the non-registered account. I don't want to use all of that capital because we're going to allocate about $700,000 to a new home purchase. So I'll go back to assets, add a new home, enter in a cost of $700,000 and a future purchase age of 75. So we're selling, buying, and then we'll reinvest the proceeds. So now we can see we're selling for 942, buying for 700,000, and the net difference gets deposited to the accounts. As a result, there's still lots of buffer left at the end of the plan. There's about 500,000 left in capital assets, and she still owns her new home outright. If we take a look at the charts, we can see these transactions modeled out. So here we have the large inflow from the sale of the home. We can see how much is being allocated to capital assets. Again, we can interact with the chart by unchecking any of the legend items to focus the conversation on any area. We can similarly see the large proceeds from the sale. We can uncheck that and just focus on other cash flows if needed. And then in the net worth, we can see where the real asset drops in value and the jump in TFSA and non-registered money. So we can go back to Sonia's list of questions and explain that she could downsize her home at any time in the plan to unlock a portion of the equity and use that towards her spending needs. And then her last question is, if she does take advantage of some of the home equity, how much would be the maximum spending that she could consider throughout retirement? So we'll copy this plan one final time, and we'll call this scenario 5, maximum spending. Right now we have her spending $54,000 a year and she has excess of about $500,000 at the end. If we click on recommendations, we can get a summary of that. So we see here $54,000 a year on average of spending, overfunded status by $570,000. And we have options to have SNAP automatically calculate things like retiring early, taking out additional savings on an ongoing basis, or increasing spending throughout retirement. So we'll click on sustainable spending, and this is determined a $59,000 maximum that we can apply to the plan in order to show how she can deplete all of her capital assets by spending at a slightly higher level. And now that we're done the 5 plans, we would be able to proceed to the client report with whatever recommended scenario we're going to proceed with. We'll go to client report. On the left, you can see all the pages available. We can select and deselect any page to include so that we can focus the conversation on our client's unique needs. Within the charts, we can customize what information to include. So we can make sure that it's as relevant to their needs as possible. We can add comments to explain what's being shown, and we can save those default comments as a pre-filled template. Once we're ready, we can then generate the report, or we can preview the report in order to see how that's going to view to our client. So we have assumptions, the cash flow chart, and additional tables and charts that you can select and customize as needed. And that's really in about half an hour how you would be able to use Snap to help your clients prepare for retirement or answer any other questions that they might have. We have had to move fairly quickly through the software to show all the capabilities. The moment that you sign up for your free trial, you will have immediate access to our help site. So if you click on help in the top right and then help center, you'll have access to webinars that dive into previous sessions that we've hosted. So deep dives on things like our stress testing feature, how to use that automated recommendation tool I just highlighted, how to present your plans to clients in different ways, and many more other deep dives. You can also search for key terms like inheritance, and that'll show you articles on how to input that into the software. And if you ever get stuck, you can give us a call, send us an email, and you can also book one-on-one screen sharing sessions to make sure that you're able to use the software confidently. Again, we really appreciate you joining us today. I'm going to pass it back to Alex so that she can take us through a few next steps and then open it up for questions.
Wow, Steve, thank you so much. That was incredible to watch you address all of those questions and create 5 scenarios so efficiently. So, as Steve just said, we know that was a lot to absorb in a short period of time, but I hope we've been able to show the value that SNAP projections can bring to your practice and to your clients' lives. During this hour, we've addressed and modeled 4 essential financial planning questions, and I hope you have learned some actionable strategies to help your practice. We've got a ton of questions, so I'm just going to move quickly here through a few more slides, and then we will see how much we can cover live. So if you're ready to take action now, you can get started with a free trial of Snap Projections. On our pricing page, you'll see there are 2 plans for you to choose from as an independent advisor. Our main module, Advisor Business, includes a comprehensive feature for corporate planning as well as data sharing for teams. If anyone wants to see the corporate module, and actually I've already had several questions about that, so we will cover it in the Q&A. Oops, there we go. So stress testing is our only paid add-on, but it's free during the 14-day free trial. So make sure you enable that right away. It's a fairly new module that will allow you to apply historical and randomized rates of returns to your plans to stress test those projections. So I'm going to drop the link to get to this page in the chat now. So click on that just so that you have the window open up on your device before the session closes out. I will send this out via email shortly. Snap plans are month to month with no contract. You can cancel anytime, and you can also switch to annual billing for a 10% discount. You will have instant access to your account, so you can get in there right away and try to model some of the strategies you have just learned today. And I did mention at the beginning that we have a special offer for all of you here today. All live event attendees who register for a free trial within the next hour will be entered into the draw to win Snap's dedicated onboarding and training package, a $500 value. You'll receive a 60-minute personalized strategy session, plus be provided with a dedicated support person for 30 days. This means you'll have priority support from a member of our customer success team who will maintain a relationship with you as you learn the program. The winner will receive an email from myself tomorrow morning. And for those of you here today who are already part of the SNAP community, a reminder that you can be earning free months of SNAP when you send referrals our way. Every time one of your referrals stays beyond the free trial and becomes a paying user of SNAP, you get a free month of service. If you believe in SNAP, sending your colleagues our way is win-win. Here is how it works. Cindy here is a current SNAP user. She mentions to fellow financial advisor Paul that she is using a great financial planning software called Snap Projections, and she thinks he would benefit from trying it out. Paul then goes online and signs up for a 14-day free trial of Snap. During his onboarding training session, Paul lets the Snap team know he was referred by Cindy. Because Paul was referred, the support team at Snap will now do two things. Number one, they will modify Paul's 14-day free trial to a 30-day free trial, essentially doubling it. And if Paul stays beyond his free trial and becomes a paying user of Snap, Cindy will receive a credit for 1 month on her own Snap membership. What this referral program means is that as a user, every time you send a good fit candidate our way who decides to stay with us, you get your own plan free for a month. If you're on annual billing, you will receive the equivalent of a 1-month credit off your annual renewal. There's no limit on how many times you can do this. 6 throughout the year would mean that Snap is half off annually for you. And for any new users who do sign up for a free trial today, this extends to you as well. And a final note on the eligible CE credit for this session. As I mentioned at the beginning, about an hour from now, all advisors who attended the full session will receive an email with the video recording that includes a request to fill out a short survey that's going to provide us with your full name and email address so that we can accurately complete your certificate. Emails with those certificates will come out no later than October 1st. All right, so let's jump into the Q&A. So we've had a number, I'm going to try and group a few questions together, Steve, just so that we can cover as much as possible. So we've had a few questions about expenses. Perhaps you can cover what happens if you don't enter expenses. Can we adjust expenses during retirement for things like downsizing a home or increased expenses for perhaps home care?
Absolutely, yes. So the additional expenses was added fairly recently. So prior to that capability, the full flexibility of the base expense feature is how people were modeling those types of situations. So if I wanted, I could actually have my additional travel included in my base expense down to age 69. So I could have 64,000 a year here and then drop that to 54,000 in any future year. I could also come down to age 85 if they wanted to assume that they're going to sell their home and start renting or move into assisted living. I could come down and change the expected spending to 100,000 and copy that down to age 100. So I can customize any blue value in any year of the plan so that I can fully reflect my client's expectations. With travel, I could also have this at 10,000 for the first 5 years, and then I could drop it down to 5,000 if I wanted and index that forward to the future year. So now I have all of these values reflecting in a customizable basis on the planning page. So you have the option to enter things on the expense page, but you always retain full customizability on the planning pages to refine numbers or add information as needed.
Perfect, thank you. And several questions about the corporate model, wondering what that looks like and what functionalities, specifically with Holdco and taxes.
Perfect. Yeah. So within Snap, you can, on the Advisor Business subscription, add corporations to your plan. So I'll demonstrate that here. So we'll just have company XYZ. And similar to what we've seen so far in Snap, there are lots of customizable settings that you'll see, but they're all pre-filled with base conservative assumptions. So if you don't know offhand or you don't have the information when you're starting the plan, you can leave the settings as are and then return to them later and customize them as needed. So we have the ability to customize small business deduction rates. We can add refundable dividend tax on hand, capital dividends, grip balance. We can control the ownership of the corporation, and then we can determine how the corporation is expected to be wound up in the final estate so that Snap can automatically calculate taxes and expected after-tax proceeds to the estate. On the left, you'll see that we have a scenario setup flow, just like we went through for Sonia. So we have assets, debts, insurance. So I'll click on any of those in order to input some base information. So we'll assume that the corporation has investments of 500,000. And we'll just invest those as 40% fixed income, 60% equity. We could add additional real assets if they had buildings or properties for investment purposes or for operating purposes. We'll click next to go to debts. So we could add mortgages or other lines of credit. We can add corporate life insurance that would track the cost base, the cash surrender value, death benefit, and all of that is integrated into the corporation to generate things like capital dividend and to automate distributions out of the corporation in the event of death. So lots of functionality available, and then we can customize settings just like we could on the personal side. Once you're done entering the scenario setup flow, you'll proceed to the planning pages, and you'll have a customizable planning page just like we saw for Sonia. So on the left, we have the active business section, and then on the right, we have the passive section. So the best thing about Snap's corporate module is that you can model both the operating business and the holding business as one single entity, and Snap will intelligently tax and treat each of those sources separately. So it'll tax the business income at the small business rate, it'll tax passive income at the appropriate rate, and then it'll have integration between the two. So if the small business is earning more than $50,000 a year of passive investment income, it'll reduce the small business deduction on the active side, and any retained earnings from the operating business will be automatically deposited to the holding company. So I'll show a bit of that here. So if I add 100,000 of active business income and run the corporation, we'll see that there's 100,000 of taxable business income that's being taxed appropriately in addition to the investment returns on the portfolio. And then the retained earnings after taxes are being deposited automatically to the investment account. Then in retirement, I could pay out non-eligible, eligible, or capital dividends. I can do so at any time in the plan, but typically that occurs at retirement. And then we can see information about the corporate net worth and how the estate taxes would be calculated in our given plan. And then that all fully integrates with the personal side so that anything that I enter on the corporation would flow through and show up as income to Sonia here.
Perfect. Thank you, Steve. And that was obviously a rapid fire response. We have some really great corporate planning video tutorials where you all can learn more about that. So just quickly here through a few more items. What do we have for charitable donations?
Yeah, so within scenario setup under our settings, we can actually enable a whole charitable donations module. So if you do have a client with either in-kind, cash, or insurance-based donations, you can enable that functionality and show fairly robust planning around the tax advantages of donating in-kind shares with a large unrealized gain. You can show the use of the tax credit and whether it's being shared between spouses. So there is a fully dedicated charitable donations with supporting videos and articles as necessary.
Perfect, thank you. Okay, and we have many more questions here that we haven't gotten to yet, but I do want to respect everyone's time and make sure that we finish up right on the hour here. So any questions that have not been answered live, we will follow up with you via email. So I'd just like to say thank you so much, everyone, for making time to be here with us today. Enjoy the rest of your day. You're going to get a few follow-up emails from me, and the one you're looking for, most importantly, will say action required to make sure you get the CE credit. And anyone who signs up for a free trial within the next hour will be entered in to our draw. So thank you so much, and I will talk to you all soon, I'm sure. Bye for now.